What's going on, junkies? Let's get it, dude. So, today's topic, real quick, get straight to the point. We're gonna talk about creative finance. I know you read the title. This is an exciting topic to talk about. I love talking about creative finance. I'm gonna do my best to try to break it down, and try to break it down for like ABC. Like I'm gonna try to break it down to where a fifth grader understands this. Try not to use too much big words or lingo that the newbie is not used to. So here goes. All right. What is creative finance? Basically, creative finance is any way of purchasing a house that is not through traditional finance. So, for those of you that don't know what traditional means, traditional finance means someone going to a bank, right? I'm going to go apply at Wells Fargo to try to get a loan. I'm going to go, give them my credit history, my bank statements, my job history, all this and that. So that's, the bank's going to go and, dot your I's, cross your T's and see what's up. If you can get, if they're going to go ahead and lend you for a mortgage. Basically, they're going to give you a lump sum in order to put into this, house that you're willing to purchase or wanting to purchase. And, depending on how much you make or whatever is going to be, they're gonna like see how much you qualify for, whatever. Okay, so that's traditional financing. Creative financing is quite the opposite. So creative financing is anything but using traditional financing. So the two main ways of creative financing is subject to and seller finance. So subject to, seller finance, two different things. For those of you that were confused about that, two different things. Subject to, they're almost, and it gets more confusing because you can do a mixture of both. And I could break down a deal that I actually have that is a mixture of both subject to and seller finance. They call it a hybrid deal. And so I own a property that is a hybrid deal. So it'll be cool in another video for me to break that down into how the numbers work and this and that. But back to the basics. So subject to. What is subject to? Subject to is basically buying a house subject to its existing mortgage, right? So I go and purchase, Bob's house. Bob has an underlying mortgage on his home. So in order for me to purchase that, I'm going to need to come up with the whole entire amount that he owes on his existing loan. If for whatever reason, there could be multiple reasons, say Bob barely bought the house like this year, 2024 or whatever, 2023, whatever year you're listening to this in, because we're at the end of the year. This is the last day of the year that I'm recording this. But Bob bought the house this year. He's already behind on payments, and so he cannot go forward with this deal before he's going to go into foreclosure. So I come in and I make an offer, and my offer is too low because he still has an outstanding mortgage. He owes too much to the bank. He's underwater. What can he do? Most people think you cannot do anything. Well, you can. You could take over the mortgage, the current mortgage that he has. It's like the easiest way to compare it is to a car, right? So I have a car payment. I just bought this brand new Honda, right? For example, and I'm paying $300 a month. I lose my job. Now I can't make this $300 payment in order to pay for my car. So what do? I can, take it back or just get it repoed or whatever and mess up my credit. Or I can have somebody else take over my payments. And that's basically it. Subject to is basically letting somebody else take over your payment. And depending on situations, like the actual seller can still, get some money. Like, everything's negotiable. So if I were to buy Bob's house, right? Bob can make a 10K profit, and I can just pay him outright cash for me to go ahead and take over his loan. And so however you structure it, it can be structured many different ways, but that's what subject to is. Seller finance is kind of the same thing, except there is no mortgage. So seller finance is taking over, or just not taking over payments, but making payments to the direct owner. So the owner owns it. So Bob has a mortgage. This guy, Jerry, doesn't have a mortgage. He owns his house free and clear, but he's ready to sell. He's been getting a lot of offers that are way too low. He's not going to sell it to anybody for less than $300,000. Well, people are noticing, and they're like, bro, your house is not worth $300,000. Nobody's going to pay that all cash. Jerry wants to get rid of his house still, though. So what does Jerry do? He finds an investor like me and says, hey, Jerry, listen, I know you've been getting lowball offers, but what if I were to tell you I could pay you $300,000 still? And just, let him answer. Jerry's like, okay, that's a deal. Hey, Jerry, if I were to give you $300,000, will you be able to give me terms? What does terms mean? Well, so Jerry, everybody's offering you 200, 150. Nobody's going to pay you that 300K. What I can do is just give you payments to that 300,000. What if I give you a down payment and I can make payments directly to you until we reach that 300,000? Boom, seller finance. So it gets super exciting because it adds like tools in your tool belts. So the biggest pros and to creative finance is that, for me, like when I found out about creative finance, is like the main thing that stuck out to me was that you don't have to have any credentials. Like the 3 C's are out the window: cash, credit, credentials. That's like, you don't have to have a job. You don't have to have cash in your bank. You don't have to have good credit. Nothing. Like, all you got to do literally is have like good negotiating skills and know what the heck you're talking about. The other things will fall into place. You can borrow money. And if you guys tuned into the last episode with Jabs, he talks about borrowing money. It's easy to borrow money when you have a good deal. So that's the craziest thing when I found out about creative finance, because originally when I thought real estate, I was like, okay, this is going to be not tough, but it's going to be a long journey. Like, it's going to take me forever to get to 100 houses. But when you find out about creative finance, it's like, bro, forget 20% down, because a lot of people think, oh, when you buy a rental property, you got to put 20% down. Now with creative finance, you negotiate that shit, and it's not going to be any of your own money putting 20% down. Fuck that. Banks ain't checking me, So that's the main pro. And the other pro is that, especially right now, if you find somebody, because the interest rates are like whatever they are right now, 7%. Interest rates is what they charge you. For those of you that don't know, interest rates is basically, it's going to affect your monthly payment at the end of the day. The higher the interest rate, the higher the monthly payment. To break it into simple terms. Okay? So interest rates are super high right now. That's why a lot of people are complaining that they cannot buy houses. When you have a market like this, creative finance is super, it's where it's at. Because what a creative finance investor is going to do is going to go target the people that do have a good mortgage rate, a good interest rate, and they're going to make offers on these interest rates at 3, 4, 2. Like COVID, they were doing 2% mortgage. And so they were giving all this cheap money. And so what a smart creative investor is going to do is going to make offers to these houses that have, cheap borrowed money, basically cheap mortgages, 2%, 3%, 4%, because their monthly payments low. And if you have a low monthly payment, then and you have a good rent on it, the spread between the rent and the monthly payment is gonna get higher the lower the interest rate is. I hope I didn't lose anybody. But that's the other main con, is that one, you don't have to have any of the credentials that you have to have with traditional financing. Two, you can take over these mortgages with 2, 3, 4%, and you can have a good cash flowing asset by taking over somebody's house that they can't keep up with or that they want to sell. So it's a win-win situation. Now we'll talk about the cons of this. So the number one main con of it is the due on sale, right? The due on sale can kick in. What is the due on sale? The due on sale is it's a clause in the contract with the banks that says, hey, if we find out that the ownership has been transferred, so like if we found out that the original owner of this house is not the one making the payments. We find out the original owner of this house is not the one making the payments, and it's somebody else that took ownership. Then we can like automatically have this whole lump sum charged to you. Like if you owe $300K, we're gonna be like, hey, we need that $300K now. We ain't taking no more payments. That's what the due on sale is. Due on sale is a scary situation for most people. But if you know the right people, like this is not financial advice at all. So take it like just whatever. You know to do. I'm not giving anybody financial advice. But if you have the right people in your corner, 9 times out of 10 you'll be all right. If you know what you're doing, like you got to do your research, and you got to at the end of the day, you have to do the loan the right way. You have to the transaction has to be processed the correct way in the correct order. That's all I'm gonna say. So, yeah, that's the scary part. Due on sale clause. This isn't financial advice. Due on sale clause is kind of scary. And the other con of it, I got it written down, so I apologize. The other con, I would think, just off top, I wrote these notes real quick, try to give you a quick little value here. The other con of this situation of creative finance, with specifically subject to, because seller finance, I mean, not as much risk as far as, it's more risk on the seller's end than it is on the buyer's end. But but the other con of subject to specifically would be really just it's harder to get the seller on board with it, right? I mean, everybody would prefer not everybody, because everybody's different. I mean, each to each his own. But most people, 95% of people who are going to want to sell want all of the money all at once. Like if you have the option between taking payments, like a payment plan, like getting monthly checks every month versus getting the whole lump sum, you're gonna choose the lump sum 9 times out of 10. It's just the reality of it. So I would say the other con of subject to transaction would be trying to get the seller on board with it, even if you know damn well it's in their best interest. Like, this is when negotiation skills come into play, and that mouthpiece is where you gotta, like, you know what I'm saying? You gotta know what you're talking about, and you gotta really set, like, it's a sell, right? You're trying to sell your service at that point. So that's creative finance in a nutshell. I'm trying to think off top, and also at the same time make this video kind of short, but I'm trying to think off top what else I would be missing. You got other stuff like novations, and we can get into that in another video. Maybe have its own thing. I honestly, novations, like, I still like, it's still kind of hard to explain, even if, like, yeah, novations is another category. But yeah, I mean, the conclusion for me for creative finance, I mean, it's dope. At the end of the day, it, like, I always say this, like, one of the selling points to, like, sellers is, like, if I go and give you, like, who wants to go get a loan to pay off a loan? Why not just take what? Because you'll have closing costs. You'll have like in this market, your interest rate will rise up, right? So your monthly payment's gonna rise up, right? So who wants to go get a loan to pay off a loan when you can just take over the mortgage? It only makes sense. Like people do that with cars. Why aren't more people doing it with houses? But now they are. Obviously, it's more and more popular. But I see a lot of people not doing it the right way, and getting that due on sale, triggered. So, I've been seeing a lot of posts on that actually. I don't know if it's the algorithm on my shit, but yeah. Maybe the banks are like, bro, Pace Morby created this wave, and the banks are like, bruh, like, we gonna watch out for y'all, and people aren't doing it right. So, but, yeah, let me know what you think about creative financing. If you think it's a bad idea, good idea. If you think, if you think it's fake, if you think it's real, if you'll never do creative finance and you're like, fuck that, I'm say you gotta learn how to save 20% and we gonna buy one house at a time. That's cool. Let me know. But yeah, we'll see you on the next one. Peace.